Is the United States on the brink of an economic recession? While this might sound like a typical sensationalist question, it's a serious concern. In the past week, numerous analysts have warned that the U.S. economy is teetering on the edge, and anxiety has surged following a sharp drop in the U.S. stock market last Monday. Wall Street tumbles over, fears of a recession. The U.S. is at real risk of recession, and it's a disaster for Kamala Harris. The primary factor driving many economists towards pessimism is the labor market. In July, only 114,000 jobs were created, falling short of the anticipated 170,000. While jobs are still being added, the numbers are below expectations, which is concerning. The real issue isn't just the current situation, but the downward trend that, if it continues, could push the economy to a breaking point in the coming months. Evidence of this can be seen in the unemployment rate, which has increased for the third consecutive month, indicating that more people are seeking work but are unable to find it. Additionally, other indicators such as delinquency rates on credit cards and car loans have reached their highest levels in over a decade. Some consumer companies, like Airbnb, are facing challenges as they report that demand in the United States is declining more than anticipated. Furthermore, the manufacturing index, which tracks manufacturing activity and is often a reliable predictor of recessions, has recently entered recessionary territory. The question now is why? What has suddenly caused the U.S. economy to appear to be on such a troubling path? Just a few weeks ago, everything seemed to be going well. Unemployment was at record lows, GDP was soaring, and Wall Street was hitting new highs. Then, out of nowhere, it all turned sour, especially after last week when the stock market experienced its steepest decline in 2 years. Did this wave of negativity catch us all off guard? The answer is no. In fact, many analysts had been warning that a slowdown or even a recession like the one we might be facing now was a strong possibility. For quite some time, this was considered the most likely scenario. As early as 2022, media outlets like The Times, relying on reports from respected analysts such as the Goldman Sachs team, predicted an imminent recession in 2023. Similarly, Bloomberg also warned that a recession could be on the horizon. While it might be easy now to criticize these predictions, it's important to remember that economic analysis is not an exact science, and at the time, it was entirely reasonable to expect a recession. This expectation stemmed from the significant inflation spikes following the pandemic, which led the Federal Reserve to raise interest rates. Such drastic rate increases typically trigger a recession because they cool down the economy by discouraging borrowing, which in turn slows inflation. It was widely assumed that a recession was the price to pay to curb the escalating prices. The truly surprising aspect was that, despite the high interest rates, the U.S. economy continued to grow, create jobs, and boost productivity. In fact, the most remarkable thing is that a recession has not occurred up to this point. However, it's reasonable to believe that even this resilience has its limits. Inflation is already relatively low, with recent estimates putting both headline and core CPI around 2.5%, close to the target of 2%. Interest rates have been elevated for an extended period, and maintaining them indefinitely could eventually lead to a recession. This is precisely what explains some of the negative data, such as the weaker employment numbers and the decline in consumption. The fact is, the economy is finally beginning to show signs of weakness, and many had anticipated that the Fed would start cutting rates as early as August. The problem? It hasn't happened. Fed holds rates steady and notes progress on inflation. It's been quite surprising that the Fed hasn't lowered rates despite signs of economic weakness, and they won't be reviewed again until at least September. The question is, how alarming is it to delay rate cuts for a few months? It seems it could be quite concerning. The issue is that economic decline isn't linear. Things can deteriorate rapidly. Economic cycles have feedback loops, meaning that what starts as a minor issue can quickly escalate into a serious problem without warning, turning a manageable situation into something much worse. Think about it this way. If employment falls and consumption drops, many companies interpret that the economy is on the wrong track. So as a precaution, they reduce investing, spending, and hiring, which in turn worsens the employment and consumption data, which again creates concerns for more companies and citizens, and it's back to square one. The result, a vicious circle that can feed itself exponentially. The way to stop these spirals of negativity is to offer positive expectations, to give signals that maybe the employment figure is not the best possible. But you go on with your business and the problems will be resolved, and that's exactly the role of governments, more specifically, in this case, the Federal Reserve, and above all, the expectation that they will lower rates. So what is the problem? Well, they haven't lowered rates, and now that spiral of negativity could escalate too quickly, making the wait until September potentially too late. Given all this, the question arises, why on earth hasn't the Fed lowered rates? Do they want to watch the economy burn? The reality, however, is more complex than it seems. Now, if you like this video, check out this next video right here.